we see no bank bailouts over this period of the late 19th century. There's a couple exceptions, but basically no bank bailouts. There were state interest rate ceilings, and there were unit banking regulations that basically left banks with just one office, and that really limited the scale and efficiency of some U.S. banks. Because of the 1929-1933 banking failures, the United States experimented with an entirely new banking regime. This is the New Deal regulatory regime, and it took a whole different tack. It included deposit insurance, state and federal interest rate controls, including Regulation Q, which basically put ceilings on the interest that could be charged on savings and checking accounts. There was a Glass-Steagall market segmentation that basically divided investment banking and commercial banking. This was all designed for a low inflation rate, low nominal interest rate environment, and that's exactly what the United States essentially had. That's exactly what the United States had, except for the wartime period of the Second World War, all the way through the mid-1970s. So we have a long period there of over 40 years where this system worked relatively well. At the end of the 1980s, at the end of the first crisis in 1982, the banking system is a disaster. The interest rate controls are a total mess. They yield a total mess in the banking system when you have high inflation. The actual interest rates are far above the controlled interest rates. There's rising international competition in the banking sector. The scale inefficiencies are obvious with the small U.S. banks. The result is that we deregulated the banking system. This led to the mid-1980s S&L crisis. The S&L crisis came about because of excessive risk-taking in housing loans and energy loans on the part of the banks. The energy loans were heavily pushed by the federal government. You know, today we talk about housing loans being pushed. If you go back to the early 1980s, it was the energy loans.
Could you wind up?
I am going to wind up. I've only got 2 slides left, so I'll wind up here. In reaction to the savings and loan crisis, we had reforms in the early 1990s. And the early 1990s reforms basically moved toward having rules in banking regulation. Okay, the rules, part of the reforms were also having more of the segmentation regulation of banking repealed. Deposit insurance was still left. The result is that banks looked at the new regulatory system of rules, where there was very strict rules put on risk taking, and they moved to put more of their assets into off-balance sheet investments. All the risk taking was moved off of the balance sheets where it could be monitored. The result then was that we ended up, I think, with the crisis that we had in the 2000s. If we look at the post-2008 banking reforms, I don't think it's really done very much. I think what we still have is we have the world's leading financial sector, the United States. We have the world's leading economy, okay, interacting with a financial sector that is still today, arguably, the world's leading financial sector with an extremely substandard banking system, with a poorly conceived regulatory structure that produces sporadic crises, not just for the United States, but also for the entire globe. Reforms of this system have often been sold as reforms, but basically they have typically been rent-seeking enterprises, in which the reforms are not real reforms, or there are obvious problems with them, and the people within the industry see mechanisms for profit in the context of the reforms. The 2010 reforms are no different. They're in general band-aids rather than fundamental reforms. The combination today is a toxic one. The combination of deposit insurance, too big to fail, and a mishmash of regulations that are based on rules, discretion. It's a financial reform bill that's over 2,000 pages, extremely difficult to figure out. Supposedly they fixed too big to fail. It's very hard to see that if you really look at the system. This leaves the world system open to further preventable crises. Last slide. Okay. The last slide is ASEAN and China, cooperation. It's really not enough in Asia. It's really not enough in Asia to think that cooperation is really going to get Asian countries to where it should. With the rise of China, regional cooperation in Southeast Asia and East Asia, it's insufficient to guarantee stability in a crisis. And this is because China has a banking system that is equally flawed as the United States. I will end right here.
Thank you very much. The time is rather short, so that
Sorry.
We would invite one question, anything? I think the United States financial market is very unique. Unique in the sense that it is very different from the financial market in other countries. The one which comes very closely linked and very close to is the European market. But even the European markets are you know, segregated into many smaller parts. And as we know, the Iceland, Ireland, Greece, such markets could not be regulated even by the Europeans themselves. So we should not mix up the financial market of the United States with others. We really have to discuss them separately. And at the present time, the U.S. financial market itself has a lot of problems. And so the present situation is somewhat different from the situation in the 30s and 70s, 80s, and so on. So you seem to deal with many problems at the same time. I think it is rather difficult. You have to concentrate on the issues in the 30s and after the war and the current situation. I think the differences are really substantial. Okay, any question? Yes?
Could you speak to some of the characteristics of China's banking system that makes it right for?
The large banks?
Yeah.
There's only four big banks.
They're state-owned.
They're too big to fail. They're state-owned banks. Their finances are not transparent. China's never had a crisis. It's going to have a crisis.
The problem of China, don't discuss it now. We have other papers. Well, thank you very much. I think we will proceed to the next one. First, the microphone.